The seasonality aspect is something we talk about post-Labor Day a lot, because since the 1950s, it has been, depending on time frame, either the worst or one of the worst. If you juxtapose that with all of the market catalysts that we are anticipating for the coming few weeks, do we think this is a weaker setup that deserves paying more attention to this time around?
I think most likely, yes. I mean, why do we have that seasonality? People go away, they go on vacation, they take a few weeks, and they disconnect from markets, and they come back and they look at things with fresh eyes, and all of the herd mentality gets taken out of the market for a few weeks, right? Because these people aren't talking to each other when they're on vacation. They come back and they think to themselves, hey, is that a little stretched? Is that, am I comfortable with how much risk I'm taking? Am I comfortable with the volatility? I see all these catalysts in the future. We have, we have a Fed meeting coming up. We've got payrolls coming up. We have all these things coming up, and they might not tell the same narrative that's actually, boosting the market. And so then they rethink things.
It's always hard to say this, and we always say it with caveats, but this time seems different, right? There are a whole slew of other macro uncertainties that are in play right now, not the least of which is tariff policy and the future validity of that going forward. Is that something to be even more concerned about this time around, or is this just something that kind of happens and it's just replace your catalyst with whatever one is in vogue this time around this year?
I think it's more the former, right? It's replace your catalyst. I mean, we worked together, right? Back in the day at an investment bank. And there was always something going on. There was always some uncertainty somewhere about something. Now, one of the interesting things that's happened recently is the uncertainty with regard to tariffs really occurred because economists got it all wrong, right? I mean, I hate to say it, but
market technicians got, and market fundamentalists got it wrong too, by the way. So
yeah, it was. There's a way that tariffs are supposed to play through the economy. They didn't. And we're left with, is the model we're using wrong, or was it a timing factor, or is it something else? And we still don't know the answer to that, right? And so I think if you don't know the answer to what's gone wrong with your modeling, then it's very hard for you to be very comfortable in terms of how much risk you're taking heading into the end of the year.
You've always had, back to our Wall Street days together, you've always had a huge tilt towards the economic part of the story and how it kind of melds with the financial markets itself. If you take a look at this time around, is the economic picture in the United States, we've seen the evidence out there. It's not like everything's crashing. Things are still relatively good. Markets are at all-time highs. Is this just the normal kind of churn that we would see, a little bit of consolidation, move higher, consolidation, move higher? Or is the economic outlook something that you have to be wary of vis-a-vis a Fed possible action later on this month?
Well, so we're more confident in the investment outlook, right? Because, just like back when, computers were kind of coming up and then the internet was coming up, you had this huge amount of investment to take place to bring new technology on board and kind of spread it throughout the economy. So AI, right? The whole AI concept. On the flip side of it, though, we're maybe a little more worried about the consumer, which seems to be buffeted by inflation, seems to be worried about AI, probably rightly so. And I think, some of the articles we saw today in the Wall Street Journal, for example, with regard to kind of the upper end kind of driving things and the lower end middle class feeling like they're being left completely behind, that's not a sustainable, that's not sustainable, and it's going to have implications for how the market behaves going forward.
It's been exacerbated since the COVID pandemic, for sure, the so-called K-shaped recovery. One last point before we let you go, very quickly, your favorite part of the market for the balance of the year?
I mean, I think financials offer the most safety because they can actually benefit from volatility, right? So they're exposed to the consumer, yes, but they have the yield curve steepening and they're exposed to volatility.